Have you ever looked at a market and just thought, what on earth is going on? Well, this year, that market is definitely silver. It has been a completely wild ride of supply squeezes, tariff fears, and just massive price swings. But it's also the perfect story to help us understand one of the most powerful and honestly misunderstood forces in all of finance: volatility. So let's get into it.
Okay, let's just start with the headline number because it is staggering. Silver prices have nearly doubled this year. I mean, that is a huge, huge move for any asset, and it's got everyone, from serious investors to market analysts, glued to their screens. The stakes are high, and the market has just been on an absolute tear.
And you know, there's a reason for these insane moves. As this great quote from ING puts it, silver is often called gold on steroids. So why is that? Well, it's because its market is just so much smaller and has this really unique dual personality. On one hand, it's a precious metal, a store of value, right? But it's also a critical industrial component. That combination means it just moves way more dramatically than gold. When it goes up, it soars, but it can also fall much, much harder.
So let's start right there. Let's take a look at what's been fueling this incredible performance. What exactly put the steroids in silver this year?
It's really been a perfect storm of factors all hitting at the exact same time. You see, for years now, we've been using more silver than we've mined, which has created this persistent supply deficit. At the same time, industrial demand is just booming, especially for things like solar panels and electric vehicles. Then on the investment side, you've got people jumping in, seeing it as a more affordable way to own a precious metal compared to gold. And then layered on top of all of that, you have the macro environment. A softer US dollar and the expectation of interest rate cuts have made holding assets like silver even more attractive.
And this chart right here shows what's happening perfectly. This is the gold to silver ratio, basically how many ounces of silver it takes to buy 1 single ounce of gold. Just look at how that line has been falling off a cliff. What that means is silver is getting more expensive compared to gold, and that's a classic sign that investors are shifting their confidence and betting that silver is going to keep climbing.
But listen, the price is only half the story. The real engine behind these massive, unpredictable swings is one powerful concept: volatility. And understanding it is the key to understanding not just silver, but pretty much any market out there.
So to really get what's happening with silver, we need to kind of zoom out for a second and talk about the nature of volatility itself. What is this force that causes so much market chaos?
Simply put, volatility is a measure of risk. It's not about which way the price is going, up or down. It's about the size of the swings along the way. So an asset with these wild, unpredictable price moves has high volatility. One with slow, steady movements has low volatility. You can almost think of it as the market's pulse. And right now, silver's pulse is absolutely racing.
And this slide just shows the difference so clearly. Over on the left, you've got a high volatility asset. See all those jagged peaks and deep valleys? It's chaotic. It's unpredictable. Then on the right, you have a low volatility asset, which offers a much smoother, more predictable path. And yeah, silver, this year, looks a whole lot like the chart on the left.
But here's where it gets really tricky. Volatility doesn't follow simple, clean rules. It has these quirky, almost lifelike behaviors. First, there's something called volatility clustering. It's this idea that crazy days are often followed by more crazy days. We've definitely seen that in silver. Then there's the leverage effect, where a big price drop just spooks the market and causes way more panic and volatility than an equally large price gain. And finally, leptokurtosis, which I know is a super fancy word for a simple idea, that extreme once-in-a-century price swings happen way more often than standard statistics would have you believe. The tails of the bell curve are fat with these unexpected events.
Okay, so this all leads to a really critical question. If volatility is this chaotic, this weird, and this unpredictable, how on earth do experts even try to get a handle on it and predict what might be coming next? And that brings us to the models. For decades, academics and financial experts have been building these incredibly sophisticated tools designed specifically to forecast this chaos. They're really trying to tame the swings. Now, in this field, there are two main contenders. On one side, you have Garch models. This is the statistical workhorse, the industry standard for decades, and it's specifically designed to capture those quirky features we just talked about, like volatility clustering. And on the other side, you've got the new challenger, artificial neural networks, or ANNs. This is a machine learning approach that basically mimics the human brain to find incredibly complex, non-obvious patterns in data that a purely statistical model might completely miss. So which one is better? Well, according to the research, it's not really about which is better, but which is the right tool for the job. It turns out that Garch models, that old workhorse, still perform best for assets that are already experiencing medium to high volatility. But the newer A&N models, they seem to have an edge when you're trying to predict the start of volatility in assets that are typically calm and stable.
Okay, so now we have our toolkit. We know silver is a classic high volatility asset, which means any analyst trying to forecast its next move is probably firing up their Garch models. So let's get back to the silver market and see what's actually been happening on the ground.
And this is where the story gets really, really interesting. Because this year's volatility wasn't just some random market noise. It was driven by a fascinating chain of real-world events that created what experts are calling a historic squeeze. Here's the play-by-play of how it all went down. First, uncertainty started growing over potential U.S. tariffs. In response, a massive amount of physical silver was moved from warehouses in London, which is the world's main trading hub, to COMEX warehouses right here in the U.S. This sudden drain created a genuine physical shortage in London, squeezing the available supply for everyone else. And the situation got so intense that China actually had to step in and ship a record amount of its own silver reserves to London just to relieve the pressure. It was a true global scramble for physical silver.
And here is the proof. This chart shows the silver inventory in those U.S. COMEX warehouses. Just look at that massive, unmistakable spike throughout 2025. That is the physical evidence of the great silver migration from London to the U.S., the very event that triggered the squeeze and sent volatility into overdrive.
Now, what's really fascinating about this slide is it shows why the market is so sensitive to these kinds of shocks. You see, up to 80% of the world's silver isn't mined on its own. It's a byproduct of mining for other metals like copper and zinc. And that means that even if silver prices skyrocket, miners can't just flip a switch and produce more. The supply is structurally inelastic, which makes the market incredibly vulnerable to shortages and squeezes, just like the one we just saw. So, after all this drama, what does the future hold? Are the wild times for silver finally over? Let's see what the experts are forecasting.
Well, the short answer is no. The volatility is expected to continue. The fundamental drivers are still in place. Another year of supply deficits is likely, and that critical industrial demand for solar and EVs is expected to stay strong. So what's the biggest risk on the horizon? A major global economic slowdown. That could hit industrial demand hard and slow down silver's powerful momentum.
And for those of you who just want a number, ING's forecast calls for an average silver price of $55 an ounce in 2026. So they don't think this year's insane pace is sustainable, but they do see prices remaining very, very strong. Which leaves us with one final big question. We have these sophisticated tools like Garch and A&Ns. We can analyze supply chains and macro trends down to the last detail. But as new risks constantly emerge, from tariffs to pandemics, you have to wonder, can our predictive tools ever truly master the beautiful chaos of volatility? Or is finance just destined to be a perpetual quest to predict the unpredictable?